Flattish on the S&P 500, but we are at historic highs. Let's not quibble about it. Let's remind everybody why we are here at historic highs. Four major factors have moved us to where we are right now. First, and most importantly, is the earnings situation stabilizing rather dramatically. That's been helping a lot. The recession fears have faded as well. And, of course, China has been bottoming. The numbers have been a little better recently. Europe's more stable. There's some controversy about how much assuredness we have about this, but the markets are saying they are more confident, and the Fed is still accommodative. There's your four factors why we're at new highs. Look at the sectors today. Bit of a mixed picture. Consumer discretionary, utilities doing okay. Industrials flattish. Semiconductors are flattish, but we've got a little bit of a problem with Texas Instruments. On the surface, you put up the semis. Texas Instruments numbers were good yesterday, but on the conference call, there was some comments about the demand may not be recovering as fast as some people anticipated. It was down overnight after being up. So maybe the question is, are we in the middle of the weakness? Or are we at the end of the weakness? It's all the bottoming question, not quite answered. Texas did open positive, those you can see. Earnings today, I'd call this a very mixed day. We heard from David about AT&T. In line on earnings, the EBITDA on the light side, Boeing was actually below expectations and suspended their guidance there. They're up a little bit. I think there was some relief. Maybe it's only going to be $1 billion to fix the problem with the 737. Caterpillar, a modest beat if you exclude a tax benefit, but not big. Northrop Grumman was light on revenues. Stanley Black & Decker was a clear win. They were 20% above estimates, and they modestly raised their full-year guidance. That's a very big winner today. The biggest problem the market has right now, I would say, is getting to positive earnings right now. So here's the good news. It's all moving in the right direction. On April 11th, we were expecting earnings for the first quarter to be down 2.5%. Today, it's only down 1.1% in 2 weeks. Look, we moved. That's why I think it's going to go to flat to slightly positive, and we're not going to have any kind of negative earnings. We'll see, but it's moving in that direction. The other problem the market has, it's getting a little pricey, folks, at $29.30. Some of these stocks are way overbought. I use very simple relative strength indicators these technicians use. It looks at how overbought or oversold stocks in the market are in the last couple of weeks. This is just 2 weeks. And you can see when you're over 70, you're overbought. When you're near 90, you're stupidly overbought. It means historically it's very difficult to move these stocks forward in the near term. It doesn't mean long term. I'm only talking about the next several weeks. But Disney, Apple, Intel, Amazon, these are the big market movers. They've just been monsters in the last move on the upside, and they're getting a little overstretched. The other thing is, what's the right multiple when you're at a historic high? Where are we in the economic cycle? You're making a lot of assumptions that the U.S. economy is going to grow, earnings are going to grow dramatically into 2020, China's going to be better, Europe's going to stabilize. So the forward PE right now, the second quarter all the way into the first quarter next year, and the S&P is 17 times forward numbers. That's pricey. The historic average is 15 to 16. Use around that number. 17, pricey. Some people are saying, oh, let's just use 2020 numbers. Forget about 2019. They're really stretching it. And then you get towards 15, you get more reasonable, and that's how they justify the current numbers. But the point is, if you want to move the market up towards 23,000 and above, you're going to have to make a lot of positive assumptions about the U.S. economy and EPS growth. And I'm going to show you that's where the debate is right now.